Crude oil future trading strategy, the evening opening hour volatility. The fundamental idea behind this strategy is when US market opens without daylight savings adjustments, 9:30 a.m. EST usually, it starts off a worldwide volatility on crude oil prices for at least 30 to 60 minutes. This strategy is about trying to find opportunity in that volatility by managing risk. Now let's see how this strategy works. As a disclaimer, I'm explaining this price behavior in Indian context. Since crude oil is a global energy product, you can take advantage of this price behavior in any market. But you will have to align the market timing of US to US market opening, which is 9:30 a.m. EST, and plan the trade accordingly. This US market hour in Indian context occurs at usually at 5 p.m. So the first thing to do in this strategy is to find out if there is a trend happening before that 5 p.m., which simply means was there a definable trend for crude oil future price during the day. If there is no trend, then there is no trade under this strategy. If there is a trend, then we can look further to define the trade. Trade decision and entry. Both trade decision and entry happen between 4:55 p.m. to 5 p.m. Now let's iterate the possible scenario that can be played out on a trending day. Imagine the crude oil price is at 100 when opened for the day. In the table we have opening price, day high, day low, and price between 4:55 and 5 p.m. and finally the decision. Out of the possible 6 scenario laid out, we can confidently trade in 2 situations only. Other scenarios all have to be studied so that you can avoid trading under those conditions. It will be good to take a screenshot of this and keep it as a reference. In 6 scenarios, 1 and 3 are the only ideal tradable scenarios. In scenario 1, we can see that the opening price and day high and price at 4:55 nearly matches. It doesn't always have to be perfectly equal. Even in a close range would be good, say under 10 price points for, and day low is in this case is 50. Hence, under this price behavior, we can expect that during the next volatile hour, that is after 5 p.m., the price of the crude oil will have a tendency to reach closer to 50. This means we have a shorting opportunity. So if the prices are aligned as such, we can short crude oil future between 4:55 p.m. and 5 p.m. It would be also good to keep a watch on the volume level as well. If the volume levels are totally off the chart, like totally out of average, then this strategy should not be applied. This strategy can be applied when the volume is also at par with what was happening during the day. Now, if we are looking at scenario 3, we can see that we have a window of going long in crude oil futures at 4:55 to 5 p.m. As you can see from the example, during the day, the crude prices have went up to 150 and now it is at 120. And even day's low is equal to opening price. And this is an important part of the equation. That is, day's low should be equal to opening price at least. Under this specific situation, crude prices after 5 p.m. will have a tendency to travel closer to 150. This creates the long opportunity in crude oil future. And as for the exit, you can exit the trade within 1 hour of entry, as we are encashing on the expected volatility.